Okay, you're up.
Okay, good morning. All right, so we do this presentation every year. There are three show estimates and revenue types coming in and upcoming items for the fiscal year that we need to be aware of for budgetary purposes. And so today we'll talk about the budget calendar for one. Like I said, the preliminary revenue estimates to include ad valorem taxes, accommodation taxes, and interest earning. Potential budget impacts, and then I threw in other items in there for council discussion and question, just in case there were items you all wanted to touch on. So look at the budget calendar. We got the workbooks out to department heads back in February. That's done today and yesterday for our retreat. That's almost done. And then our revenue estimates are due back to department heads today. So we'll get those items knocked out the way. And then you see we gave the department heads another 3 weeks to get their expenditure estimates completed and turned back in. And then I think that's the first week of April, maybe first week and a half of April. Chris and I will meet with the department heads and go through the budget line by line. And one thing you all should be aware of, I think we talked about this already, is on April 22nd, we have a special budget meeting scheduled. And that's where we'll present the preliminary budget to the council and have discussions on that. Any potential changes from that meeting will take place between then and May 4th, when the manager's recommended budget will be submitted to you all for review. We'll have a public hearing at the regularly scheduled May meeting on the 15th. And then we did have a placeholder in here for a budget update workshop if that's needed. And then it's recommended for adoption of the budget at the regularly scheduled June meeting.
That'll be a Thursday, June 18th.
Oh, missed that. Sorry.
Yeah,
I think it's
the May 4th date. What is that? What's the format for that? Is that a meeting or is that just the budget will be, our booklets will be out?
Yeah, I think it would be an email. It's the annual discussion is whether it's a presentation or a presentation of the budget. It's a presentation of the budget.
Right.
So,
Sorry, did you say the 22nd is not the right date? Darcy?
No, it is.
No.
April 22nd is the
Okay.
correct date.
Got it.
June 18th is a Thursday, not a Friday.
Juneteenth is on Friday. Thank you for that. Okay. We'll get into our preliminary estimates for ad valorem taxes. I wanted to go through current rates of the village. Current village-wide base rate is 65.6507 cents on base. And then if you're in MSD Zone A, it's another 6.68 cents. And if you're in B, it's another 3.83. And you can see the total tax rates for those respective areas. And then I wanted to note that 0.0613 of this village base tax rate is utilized for the repayment of the beach renourishment GO bond. If you'll recall, last month we transferred money out, reallocated a portion of the tax rate we had appropriated for that back into the regular rate, which I'll show you now. The tax formula, the tax revenue formula, total property values divided by $100 times your tax rate. That's how you get your tax revenue calculation. And so we'll go through what our our total base tax rate is broken out here. So like I said, current distribution here is 58.94 cents from the total base tax is not allocated to beach renourishment debt. We have a portion of that, 6.13 that is. With property values as of October 31st, that's what we can expect in revenue to come in based off that. But it's about 12.4 million to come in. Top of that, from MSD Zone A, we have about 275,000 coming in based on the property values there and that tax rate, and about 220,000 coming in from MSD Zone B.
Zach, my apologies if I missed this earlier. How often does the property values get reassessed?
So we do a reval every 4 years. And the last one was 24. We talked about this.
It's
Yes.
not much.
Yep.
So-
And so I was saying, I think the next one will be calendar year 27.
So that's to say that then that revenues that you list here will stay the same until 27, or is there something else that would inflate that?
Yep, and we'll get to that because
Okay, thank you.
We anticipate additional properties coming online during that time. That like new construction.
New homes.
But just, okay, so just to finish that off then, so the increase is only going to come from new homes being built out, new build out during that period until we do a reassessment.
Yes.
Thank you.
Well. All right, and so from those tax rates, this is just another way to show it how the properties in the non-MSD zone versus the two zones, where the revenue actually comes from, how that looks overall from those areas. So next year, this year, we're looking at about 12.9 million coming in from ad valorem taxes. And so just to summarize this, right, this is available for general use right here on the list. These three amounts are about 1.6, 1.7, for the total 12.9. And so we'll carry those over so we can show the debt that we take from the taxes, because you have to budget for your debt that you have to pay next year. That's statutorily required. So this is just a total figure here, 966,000. That includes the public safety building that's currently on the books. I think that's about 822,000 this year. And then we have the public safety vehicle loan, the one that's 1.05 million. Its annual repayment, I think, is 138. So it's about right in that ballpark. And so after we take that out, leaves us with about 10.3 million. On the other side with beach debt, we had the last payment of the 2018 beach renourishment bond. That was about 1.3, and then the first payment and interest on the 2024 GEO bond, about 1.5 this fiscal year. So when you take the revenue that we have coming in from ad valorem taxes and you subtract those two GEO bonds, it left us with a deficit of 1,097,000. Okay, that's okay, because the GEO bond proceeds that were remaining are covering that. So we're not transferring any accommodation taxes out. It's strictly GEO bonds covering that amount that was remaining. So we add that back in, and that's still our available funds for operating per year. So when we look at next fiscal year, we have some assumptions. So Jesse, back to your question with the revaluation cycle. Here is what we calculated last go around with the village's average annual growth rate. It's 1.2% annually. And so when we take the property valuation and multiply that by that 1.2%, we are anticipating about $23 million in growth, property value wise. And so that translates into an estimated overall revenue increase of about 155,000. And you can see the breakdown with the island-wide and the two zones. And that assumes that everything is held equal, right? Like the property value, whatever this percentage is in both of these zones is held constant.
And that's basically just new homes coming online, right?
And it also assumes we would keep a constant tax rate.
Right.
But I do want to put a caveat in there that the public safety building installment loans final payment is in December of 26. So we're only paying half a year's worth on that, about 404,000, I believe. So we start with that tax rate again, and our property values have gone up to 1.93 billion. You'll notice here that these are different, right? Because we're going back to that original tax allocation that we had this current fiscal year before we took the GO bond proceeds into account. So in the previous calculation, this number was 0.58 and this number was 0.06. We're moving that 3 cent back over, and I'll show you why. So when we calculate all that out, it takes us down to 10.8 million in revenue and 1.8 in the beach debt revenue. So we increased overall total by about 149,000, I think is what it was. And you see a small increase in both of the MSD zones.
So just doing some quick math on my own here, what I come up with is that our revenues as a village are not going up as much as inflation.
For the ad valorem tax, that would be a fair statement. Yeah, because if we're only doing 1.2% increase on that, and you're not changing the tax rate too, right?
Yeah. There's no criticism. There's no comment there. It's just making sure it's a clarification. Yeah.
Yep. It's the same calculations here. I think previously it was the 12.4 and 12.9, and we went up 155,000 on the total revenue side here. But what you will notice is when we move that 3 cent from this allocation over here, that went up about 400,000 plus there.
Zach, we moved that over because of the GO bond. Said the GO bond proceeds that we didn't expend that we put back into the fund.
Correct.
So that we don't have to expend.
But it's a one-time thing, so you have to make up for it next year somehow. I think before it was about 1.66, and after we reallocate that, it takes it up to about 2.26. So when we take into account the 2 loans that I mentioned earlier, this amount went down to about 542,000, which is good because that helps us out here with the total revenues available for general use. On the beach debt side, with property taxes accounting for about 2.26 million, the total owed next year on the beach renourishment bond is about 2.76 million. And that leaves us with a deficit of about 495,000. So what we do there is we transfer accommodation taxes out of the BRAT fund into the general fund to cover that deficit. Overall, when you look at this, what's our current net position right now in terms of funds available for general use current year versus next year? You'll see a deficit of 21,500. Okay, stay with it. What that shows is that our current tax revenues, right, from prior or the current year calculation to this calculation have gone down because of the reallocation of the GO bond debt, right? Gone down by about 445,000. And offsetting that partially is a decrease in the expenditures that's not as much as the decrease in the revenue allocation. So the general fund debt expense went down by about 423,000. So that's your change there of 22,000. And what that is made up of, it's somewhere in the net, I guess, of that revenue difference. That's the net of the 570,000 that we're moving back to the GO bond debt, offset by the increase of 149,000. So you see a decrease of about 445, right, that we're using for the general use applied to the beach debt. So there's a lot of moving numbers there. It's a lot. But essentially, the revenue on this side is going down by 445, but our expenses are also going down by 423. for a net decrease of 22.
So the bottom line there is we have 21,500 less next year to use than we had this year to use. Is that what you're telling me? Basically,
Essentially, yes,
for use for things other than debt service.
correct.
Yes.
Based
I
on
believe the rest of the numbers. I have no idea.
Yeah. So I hate those yearly estimates because they don't. We'll see what they come in next year, depending on what new properties come online and how they happen.
That gives it a part of that because we're having to pay the 2018 bond completely off plus the 2024 principal and interest payment in next fiscal year.
It has paid off this year. The 2018 bond's done that.
Okay.
Okay. Um,
Zach, just a question. Every month, Stephen gives us a report about construction in progress. Can you use some of that information to guesstimate what the values are going to be for next year? Because houses will be finished and you can tell from that.
guess it would depend on what type of house and the size and the rooms and what the square footage at the time is. And I mean,
Well,
analysis-
the report does give us the square footage. It doesn't tell us, exactly what the layout is, but it tells us location and square footage.
Yeah.
Just a suggestion that might help for planning.
we probably could do an analysis of that. It would, like I said, we'd have to know that valuation of homes at the time, like the comps that have sold also. So it'd be a pretty in-depth analysis, I think, instead of just using a general, this is what our past growth rate has been over time. I mean, it could be done, yes.
And maybe it's just a ballpark of and we think 5 houses will come online or 10 or whatever the number, just a suggestion.
We'll get into accommodation tax. So we'll start with our previous 5 fiscal years in terms of cash collections for accommodation taxes. And by popular demand, I had switched the order that I reported these in last year. I think it's, or the year before that. They've always been backwards. That's just how we've tracked it over time. I flipped this table around to make more logical sense. So you'll see we'll start in FY21. It was right at about 2 million. In 22, we took a big jump of about 200,000. In 23, it came back down a little bit. 24 dropped a little bit more. And last fiscal year, we climbed back up to about 2.12. Over time, those averages by quarter are here. And then the average of the 5 years is about 2.11 million.
And that's a flat 6%. That's a flat 6%, right? We don't,
Oh, yes, the accommodation tax.
we don't change that. That's a state statute.
Okay.
So Zach, then a way to understand that drop from 23 to 24 would be that there were less rentals. Is that right?
Yes, or they charge less.
Okay. Yeah. Either case. Yep. Gotcha.
Less rental revenues, I think, is probably.
Yes, that's the right way to say it. Yeah.
But it is safe to say that between 24 and 25, the rental revenues on the island went up. I mean, by a small amount. Unlike what you hear, which is that rentals are down 15%. Right. Okay.
I think they're probably reporting the difference between occupancy and rate.
I understand, but there's also more houses being rented. So,
Right.
Yeah.
But yes,
So when we look at current year projections for fiscal year 26, we take those averages. We've already collected through our first 2 quarters here, and you can see how they compare to the average collected in the prior 5 quarters, prior 5 years for quarter 1 and quarter 2. And then applying those averages to the remainder of the year, it gives us this total at the bottom here of about 2.14 million. And that's just using straight averages to calculate that out. And to note, our budgeted amount is about $1.2 million. And so walking through that math here, what I just said out loud, our current is about $1,680,000, which are these two first quarters. And that puts us at $135,000 under budget with 6 months remaining in the fiscal year as of 12/31. And so using those prior year averages, it's possible that we could see a revenue surplus of about $317,000. So that's the estimated FY26 minus the budget amount for accommodation taxes. That gives us the 317.
So Zach, I'm not sure I understood that. Could you go back for just a sec? So
Yep.
I thought what you said was that we had less revenue in the first period, first 2 quarters, and but then you were assuming that we're going to have more revenue for the full year than was projected. Did I state that wrong?
Yeah, did I say that right? So in Q1 of fiscal year 26, right here in the lower right-hand corner.
Yeah.
So we had an increase, or excuse me, not an increase, but the amount collected in that first quarter was over that last 5-year average, right? So about.
And the average is your budgeted figure.
No, sir. The average is, we calculated that number last year, when we were doing our budget process. And I'll show you how we calculate that on the next couple slides. But that average is the last 5 years in that particular quarter. So that table in the top left, in Q1, you can see FY21, 2, 3.
Yeah, no, I got that. Let me just, so I'm confused because you're showing average. Where is your budget? What did we
Right here.
budget for this
Budget was
one?
1.8.
Yeah, right here in the lower left.
So we're budgeting 1.8 versus historical average of 2.1.
Yes, and the reason for that is because, like you mentioned about the rental revenues coming in, it's a volatile revenue source.
Okay, gotcha. So
The budget was
Gotcha.
the budget was a different set of years though.
Yes.
Jesse, the budget was set
Thank
from fiscal year 2020 through fiscal year 2024 when he set that.
I see. It's not redone each year.
When we looked at the 1.8, FY20 was still online with this particular calculation. And I want to say that number was particularly low because of COVID that year.
Okay, I got you. I said, so Scott, I understand what you said. The calculation was based. Okay, I got you. Thank you. Thanks for that, Zach. I got you.
When they set that revenue number, they can only use the 5 years preceding then. So now we're a year further ahead.
Yep.
This ties into the budgetary calculation for next year. And we pull over that FY26 calculated revenue. And you'll see here, when we take that 5-year average into consideration, we include the FY26, it increases our average by about $5,000. So we're maintaining, right? That gives us a good sign that it's pretty steady. So this is visual. And you can see when we, like Scott said, when we dropped that FY20 off, which was about down here between the 1.5 and the 1 million, where our average was skewed a bit, now we're starting to level off. The good sign, I think, for a volatile revenue resource. And when we talk about next year's calculation, we use the FY26 estimates included for the last 4 years, actuals, and our estimate goes up a little bit higher. In years past, we've always used a 90% conservative estimate based off of this number, which takes us to about $1.92 million, which is about $102,000 over the current budget amount. And that's where the calculation comes from. Like I said, it's a volatile revenue source, and we'll just use that 90% as, hope we make this market doesn't go down. So
When you say volatile, is that, I realize rentals are volatile just in general, but is it volatile because of payment processes as well? Because sometimes it comes in faster, sometimes it comes in slower. Or do we recognize it based on when it's paid or when it's incurred?
So these numbers are based on cash collection.
Okay.
So it's going to be the month they were collected for.
Okay.
Uh,
So there's some volatility just in the payment process. If people slow down a little bit, then we're gonna, one year could be lower, but the next year could be higher or vice versa based on just payments. But
Well, with that though, you have until the 20th of the following month to submit your payment to the village. So January's payments were due February 20th,
okay,
right? So they have.
I mean, I assume that this is audited for most renters now.
And, you know, we do have a software that helps us track properties that have listings online.
Okay,
So this also allows for online remittances, where it's 3 years ago, it was all paper, where they were having to mail in remittances. So that has helped, I think, with collections. We could do a better job of that, but I think all beach rental communities in the state could do a better job of that. And just networking and reaching out to other communities, everybody practically does it the same way. It's Excel spreadsheets, right? And they track it that way. But there is a lot of room for improvement in that process statewide.
do you feel like we're leaving any substantial amount of money on the table by, I mean, how many people are cheating, I guess is the question.
How many people cheat on their taxes?
Oh, no.
We would have to research.
I'm just, do we think it's 100,000? Do we think it's 50,000? I mean, it's certainly not 1 million, I would assume. But
I think if I can't give you a variance.
okay, all right, that's fine. That's fair. Yes.
So jumping from accommodation taxes into interest earnings. And same logic applied here. So we look at the prior 3 fiscal years and the average of the revenues that came in. And you can see here last year, we brought in about 715,000, which helped bring our cumulative average up to about 585,000. And just going back and looking, I think in 22, we were hitting the post-COVID turn up, but it was way lower than 377,000 just because of how markets were at the time. Did want to point out that the 714,000 based on prior year valuations was about 3.8% tax rate. However, note that that's just a comparison number to use. Obviously, not all of our interest earnings are just in the general fund. They're spread out across all funds that we have.
So Zach, just, okay, yeah, no, go, I'll listen, sorry. I see where you're going. No, you might be answering it right here.
All right. So we look at the current fiscal year projections, same, logic applied here. We take the last 3-year average. These are our current Q1 and Q2 collections under that FY26 column, utilizing the prior year averages, calculating out the remainder of the fiscal year. We're estimating about 707,000 on that return, which based on current property valuations is about 3.71% on the tax rate. And our, the total current collections here as of December 31st is about 367,000. Essentially, if markets held steady, you could multiply that by 2 and say, well, we may get about 725,000 if the rates stay steady. But again, they're volatile also. They're based on ongoings.
I think having the symmetry of methodology makes more sense, honestly.
Jesse, do you have a question?
Yeah, so this is tax money that we've collected that before we spend it. Is that where this interest is coming from?
The interest is earned off of the combined cash, whether that be from tax revenue or utility fees.
Got it. But it's essentially collected before we need to spend it.
Okay.
Yeah,
Okay,
so it's
yeah,
the
gotcha.
interest we're off that, and that's why we allocate it to the different funds to make sure that the pools of money are getting the correct interest allocations for each type of money. Because we have to keep everything in separate funds and pots of money, so
Gotcha.
that distribution is correct.
Okay, so it's in the ballpark, of probably 20 million.
I
Work out
think
the rate.
today, when we talk about it, just of how the tax revenue collections came in for January, how they lie, I think our total cash on hand is 25. But we won't get hardly any revenue any more revenue in the general fund till the end of the fiscal year. Like, because all of our taxes come in
Right.
January.
If you take the unallocated fund balances, it seemed to me when I looked at it, it was about 10 million,
Yes.
5, 2, and 2.
Sorry, I was talking cash balances.
No, that's fine. And so that money is money that we could invest. We couldn't, so we're looking at basically a $10 million portfolio that we have, and we're getting 3% on it, which is not that good. I understand we can't go out and put it in the stock market. But it does seem like that some of that money, depending on our discussions going forward, could be put into something that earned a little more interest at a more predictable rate. Is that fair to say?
You can always take the funds and invest it in long-term investments, because the village does have an investment policy in place.
Okay,
I'll get that to you.
that's fine. Yeah. Okay, that sort of answers. Yeah.
I'll say approximately 3 years ago, we actually expanded the portfolio to where we were, the village was using a money market account and the North Carolina Capital Management Trust, which is a pooling institution for local government statewide.
Okay, cool.
We've since increased that portfolio to about 3 different institutions that do the same thing, and they all get variable interest rates.
Right.
So we try to diversify that portfolio as much as possible. I will leave the institution for a quarter point that helps us out.
No, because if you took $4 million and we said, we're not going to spend it for the next 12 months, and you put it into a 12-month CD, basically, split it up so it's not at risk, then you could end up with, over 4% today. And that might be worth something we consider. I don't know what you're getting. Maybe you're getting more than that. So that's good.
I think the current average is about 3.8 right now.
Okay, so that's in the ballpark.
Yep.
That's fine.
And
Okay.
some of those institutions do offer term investments, which is also allowed by the policy, but we can talk more about
Okay,
that.
that's fine.
What's our current year projections? And we'll look at 27's estimates. So again, like foundation taxes, when we take those estimates for 26, it changes our 3-year average by a little bit. Our 2-year average is about 688, and it shows us about an increase in about $6,000 in the average interest earnings for the calculation in 26, plus the 24 and 25. Here is the trend of interest earnings. As you can see, in 23 we were lower based on what we talked about earlier. And I think since about 24 on, we've kind of been pretty consistent. Even though the trend line's increasing, I think if we moved it over, it would show a little bit more flat earnings on those funds. So when we look at 27's projections, take those averages we just looked at. We also apply 90% conservative estimate to that. Gives us a preliminary projection of about 625, which is a decrease over the projected amount of about $82,000. So that amount was distributed, like I said, amongst those funds. And you'll probably see a small decrease in those numbers, just because we're not sure how those interest rates are going to fall in the upcoming year. All right. Any questions on that? Send it away. So real high level potential budgetary impacts in terms of operations. New position requests obviously will have an impact on budgetary figures. Last year we did not add any new positions, but we did reclassify one from IPC to IT split there. COLA and merit adjustments, obviously that'll have an impact as well. In 26, we did a 3% COLA and a 3% merit for employees. Inflation rates. So CPI as of December 25 was about 2.7, whereas last year was about 2.9. So those inflation rates obviously can have impacts on personnel, operating, and then capital budgets as well. And then any changes to maintenance and upkeep with parks or right-of-ways or infrastructure or buildings that can obviously impact operating budgets as well. And we look at debt service and capital outlay. The capital outlay needs are obviously one-time expenses, so they impact each fiscal year differently, contingent on what your needs are. In 26, our current appropriations in the general fund are about 1.3 million for capital and about 950,000 in utility funds. That includes transfers out of those funds too. So like the 200,000 transfer to the reserve is considered a capital expense because we put it aside capital outlay. When we talk about debt service, these are all the loans that are still online as of fiscal year 27. We have our ambulance loan. It was I think 371,000 when we took it out. That is being paid for by the FEMA funds that we received for that ambulance. And contingent on where that interest rate falls in the upcoming year that we're earning interest on, we may look at paying that off early. The public safety vehicle loan, the first one, that was about 1.45 million. We have about 355,000 left to pay on that next year. And then I mentioned this earlier, the other public safety loan, we have about 139,000 to pay on that next year.
What rate are we paying on all these debts? You know?
Not off the top of my head. We may have one. I think they're all under 4%. Where they fall on that line of 3 to 4. I don't have that.
No.
Which goes back to if the money we receive from FEMA is earning more interest, because once we get it from FEMA, it's signed, right? And so once we earn interest on that, if we're earning more interest on what the debt interest rate is, it makes sense to hold on to it, right? For beach renourishment, we talked about that earlier. And then, like I said, the public safety building installment finance on that comes offline. And then we have that contractor services loan for the property out here. That's paid with contractor service fees, the rentals on the building, pay for that loan itself.
The balance on the beach renourishment is 18.
That's total. Balance on the beach renourishment is
Because
probably
we just started paying it, right? So
this year there's about a 1.2 in principal, so I think it's 14.5 current remaining.
Yeah.
So total debt next year is about 3.83 million. And I just had some other items up for council discussion if you want to talk about it. I did plug in, I love chat, PPP, right? And I plugged in, give me a nice painting picture of all things Bald Head Island that you pull from anywhere on the internet. And at first, this turtle down here is more like the platypus. I don't know what happened, but now it looks like a turtle. So, and I didn't know if there were any items out there you wanted to talk about, to go through, or if there's something you want staff to look at going into the budget process on the finance side that we can research.
Zach, let me just tell you, let me see if I run something by you. So what I heard you say, please let me know if I have this right, is that revenues roughly are going to be about flat next year and costs are going to go up roughly about 3%. in fact more than 3% if we throw in the labor merit increases.
So yes, on the relative flatness of revenues, the cost increases are going to be subject to budget requests, personnel, inflation, and what our COLA or merits look like benefit wise. Is that fair?
Right, but assuming same services and same, yeah, okay, that's just good framing as we think about our, the rest of the discussion. Thank you. That was very useful, by the way, that whole presentation.
So one of the things that I know we talked about before with the budget meetings is, and I don't know if it's in this one or the next iteration, but I hope we'll include it, right? Is efficiency gains along the way, right? Because I don't think we highlight those, right? Because we end up in this circle where we go, the budget ends up being whatever I had last year plus, right? And that plus, yes, Jesse, will add up to more than, the difference in what the revenue is this year. But we've done some things, right? We've bought some technology that should save us some labor expense. We've put some folks in the satellite office over in Southport, right? So that I would think that, right, there should be a commensurate like savings on transportation or something like that. And those aren't always easy for me to discern from the packet materials where we've, where we've gotten gains of efficiency or productivity along the way. And I'm hoping you guys can call that out for us somehow. Does that make sense how I'm asking that? Because if we, let me say it differently, if we didn't decrease our spending on transportation, for instance, but we are renting office space over in Southport now, then we should stop doing that and bring them back over here, right? Or figure out what we're doing, because we made those investments with the thought that they would, help us be more operating efficient.
Right.
Do we, in that scenario, in that example, do we factor in, because at one point we were looking at Vraith and how many of us were in Village Hall of if the land purchase to build a new Village Hall?
Yes.
For the foreseeable future, given how we're operating today, I couldn't foresee
It's a
us.
soft number that, yeah, and you got to the point where we're sitting on top of each other in Village Hall. So there's an added expense that it had to come out somewhere. Either gotta get those people out of there, or we need to add on to Village Hall. How do you add that into the number too?
You also have the potential difference in pay, to attract and retain somebody that's working off island versus attracting and retaining somebody who's working on island.
Yeah.
So it's very difficult to get a number on that.
Yeah.
But I agree with you.
I mean,
But if you're paying extra money.
yeah, it's difficult, but we got to figure it out, right? Because when we get, and I'm borrowing on that one because it's front of mind, but right,
Yeah.
like, I mean, some of the other ones would be, much smaller. Like I remember we bought some technology to reassign the stickers or whatever that the nice lady out front used to do. Well,
Right.
that should have freed up half of her time now, right? Or probably all of her time in that first quarter of the year or something, right? Yeah.
Maybe not the
Yeah.
first year.
But you get what I'm saying, right? When we're making these investments and things that are supposed to be going up, we should discuss those and make sure that they're making it into the budget exercise as well. So that we don't end up in this perpetual, well, my budget was $1 million last year, I need $1 million
Right. No,
plus
I got it.
30,000.
So that difference that Scott's talking about, that should show up in the budget process.
Yeah.
Even if it's not highlighted or, codified as, hey, this is what we just saved $450 right here.
Yeah.
But if you're looking at,
So for example, if we look at the line item for transportation for ferry tickets, we should see some decrease in that as an example.
And I mean, I know how we end up doing it. I think we would end up having a discussion about that, right? Because I mean, that's what I do when I get that handbook, and you remember me doing this, right? Is I look through it and I look at which bogeys are considerably higher than before and what's driving that, and which ones are considerably lower and what's driving that, right? And so that one I think could be a good news story where you say, hey, our travel budget went down by whatever, but it's because we have whatever, 10 or 12 people sitting over in Southport now. And, you know, their commuting went down or parking or what, you know, whatever the expense goes with it. Yeah. So,
Yeah.
it's not immaterial, but yeah.
We'll be cognizant as we work through the budget to highlight those where we find them.
Good.
Zach, I had a question about,
Yes, sir.
and I can only ask this question based on this year's budget because I can see it online. I have no idea what you guys really haven't put together next year's budget yet. But based on what I'm seeing, we have in this year's budget, we got a $600,000 contingency and we've got a 700,000 plus in legal fees budgeted. At this point, I understand, I don't think we've spent any of the contingency yet. And we'll probably end up with 200,000 to 300,000 in legal fees at the end of the year, guessing unless something else happens.
Expended.
Expended, yeah. So we have that's $1 million basically of money that's in the budget that we're not going to spend. We think we're not going to spend it. We don't know because there's a lawsuit could come up and we could spend $1 million in legal fees. But whatever. Yeah, that's right. That's a different budget. So, and we also have $5.5 million of general fund balance that's unallocated. It looks to me like from a budgeting standpoint, we should not have a contingency and we should dramatically reduce the legal fees. And we should use the general fund balance, the unexpended general fund balance as our cushion. So that would do two things. One is it would dramatically reduce our expenditures budgeted by $1 million. I mean, there's $1 million right there. You just take off the expenditure line that this year we didn't need. Not saying the budget's bad. I'm just saying it's a different approach to how we would look at these. And that would mean also that if we want to spend those dollars, I think council would have to approve moving that money from the general fund into the budget allocation, which would, I think in the long
Or
run.
they need a budget variance or whatever.
Right, in the long run would be a positive. So it looks to me like, and if I worked out the numbers, that would mean we could reduce the tax rates by about 6 cents per hundred. Without changing any of the other budget lines. So none of the salaries, I mean, it doesn't have to ripple through to all the other lines. It's just those two lines would save us 6 cents per hundred or more. It depends on the actual numbers. You know, our budgets are pretty conservative already, and we're adding a 90%. You know, you look at that, it's highly likely in my mind that the accommodations taxes are going to meet this year or be close. It's probably not going to be 90%. Interest, who knows? It just looks to me like if we took that approach of, you know, we're being conservative on the revenue side and we're being really conservative on the spending side, and we're creating these big balances, we ought to do something different. And to me, you know, we're getting ready to ask people to pay $1,500 a year more in utility bills. You know, we at least ought to be thinking, gee, we got all this money. We need to be reducing that in the future, or we ought to be cutting taxes now and telling people, look, we don't need all the money we're getting from you right now, but we're going to need it in 3 years when we start building this thing. So you're going to see, I mean, for a person with $1.5 million home, that's going to be almost $1,000 a year, less money. So I'd love for us to look at that approach. And if you want to have that as an alternative and say, this is how we've always done it, this is what this would mean, I think it would go a long way towards helping the village's view amongst the residents. If we could say, look, we've gone through the budget and we think we have enough money to handle the emergencies. And so we don't need to collect as much every year from you right now, but be prepared. Don't spend all this money that you're going to get back this year, because you're going to need to spend it in 3 years once we start charging you for the new sewer plant. The alternative would be we need to start taking that money that we're getting today that we don't need and put it in a fund for the sewer plant. But that's gonna reduce that. We need to look at how much that's really going to affect that amount. It's going to go you know, you put 5 million into a $45 million project, you're still going to raise your sewer fees by $1,400 a year instead of $1,500 a year. It's not going to be, but you tell people we're cutting your taxes by 10%, that's going to be a big deal. And I'd really strongly encourage looking at that.
Yeah, I don't have, yeah, but looking at it is one thing. I think that
I hate that, I got a comment back from somebody in somebody's presentation that we don't want to lower taxes because it's harder to raise them. I don't ever want to hear that comment again.
Yeah.
That really pissed me off.
Yeah, and there, it made some reference that the tax cut is permanent and it's not. There are no permanent cuts.
Raise them, it takes just as many votes to raise them as it does to lower.
And we've done that. Yeah, agreed.
yeah.
But
Go ahead.
I was going to say, we have had discussions about building more, planning more for the future. So building more for road work and building more for money, saving money toward future projects instead of coming up to those projects and not having a fund developed to help take care of them. So I want to make sure we can consider all those plans at the same time that we consider everything else.
And I agree.
My voice.
I completely agree, but I don't think collecting the money in taxes today with no plan to use it is the right thing to do. I think it's cutting the taxes today and then saying, hey, we're going to have to raise your taxes next year because we need to build this fund to do this. Right now, we're collecting taxes with no intention of spending. Or with intention of spending it on stuff we can't tell you about, which is what we have. We have $5.5 million. I know we can't spend all $5.5 million. I get that. But, you know, we could spend a couple million of it and probably be okay. And it looks to me like we can collect less money, keep that couple $1 million as the contingency. That's a lot of money.
There were many years that we, one, didn't have a contingency fund, and two, we used fund balance to balance the budget.
Right.
We were in the neighborhood of 350,000 to 1 year it might have been 750,000
for capital. We need to clarify that, right?
So that's where I can't, when I look at the budget, last year's budget, there may be $2 million of capital that needs to get done this year. I don't have any idea what that is, but so that would be my last comment here is I don't know what there is in terms of projecting forward. You know, we have the capital plan that was delivered. That helps a lot in terms of looking at your capital expenditures over the next 10 years.
For water and sewer.
Water and sewer, right.
So Slaughter's comments are.
I would like to see, you know, something that says, hey, we got this money. How much do we, of that $5.5 million, based on, not just based on our sitting around saying, oh, it's kind of a comfort level, we need 3. What do we really need over the next 5 years? I don't know. 10 is way too long out. You can't project that far, but
I thought there was a comment about adjusting the tax rate, but to set up a reserve to help cover utility costs, which remind me that the tax rate, that's 2 separate pots, right? We can't use the tax rate to generate revenue to then help pay for capital needs in the utility enterprise fund.
I have a on hold discussion with the School of Government on that basis.
that's the other question, Zach. When I was thinking through this, I'm like, I don't even know if we can do this. So, you know, that's a different.
School government hasn't put out real clear guidance, and I gave it with Zach last year. And in fact, that there is some suggestion that you can do at one time, make a movement from the general fund to a utility fund. But he's getting the definitive answer, so don't let me opine on
The
that.
interesting part of that is if you don't do it now and you end up in a shortfall in the utility fund, where's it coming from?
Right.
Yep.
The
There's some
going to do it at the time as opposed to doing it later, but.
there's some question on if you do that transfer, how it impacts your ability to get grants and stuff from the state future, and we would not want to impact.
No, that's
that
right.
at all. So we're trying to get that definitively worked out.
Well, it also could create some flexibility issues down the road that you put it there and you're like, we put a little too much over there. We need it over here. We don't want to
Can't do that. Yeah, and you can't do that. They're clear on that.
Rather stay in the general fund and have just the council commitment that we're not spending it. We plan to spend it over here if we need it. Because I don't think we want to completely hamstring, you know, future years by something that we do now.
And just to address the contingency part of that question, right? So that was implemented, your fund balance, you typically want to use that for capital expenses. So it's larger items. This is tangible, we want to buy this. The LGC typically frowns on using fund balance for operational expenses, which is kind of one of the reasons that we incorporated that contingency aspect, just in case items came up that weren't pre-planned for budgets to be able to pull from current year revenues to help with operating costs if they arose. So that's okay.
Yeah, but practically, we didn't end up using it.
But the problem with that is that, we talk, legal fees are a great example. So we recently had $250,000 to whatever, 190,000 we needed to move. Or that we needed to spend that we weren't planning on spending in a particular area. That's not, it's operating, but it's a one-time thing. That was a one-time response to a particular issue. I think there's other situations like that that were in the budget. We had 200,000 for, as I recall, a fee study.
Or feasibility study.
Right.
Brat fund.
To me, that's a one-time thing. That's not an operational thing. So I don't know if that was in the operational budget or whether it was in the.
Brat fund.
Okay. So things like that are, sure, they might happen. There might be one of those every year. So we put it in the budget. If it's a different thing every year, to me, that's a one-off thing. And we could budget for it from a capital standpoint or from a outside of operations standpoint, but
yeah, we should definitely get rid of the contingency.
I feel like we've got $1 million in our operational budget that we're really not planning to spend. And $1 million is 10% of our tax rate.
Hey, Laura, can I just ask, you touched on this earlier, but I can't recall exactly where you went with it. Why did you not suggest that we use that excess with that money to more aggressively pay down our debt?
My impression is that we're actually making money on our debt generally. And so I don't know that it makes sense to pay off debt at a lower rate than what we can earn.
So, so that's that delta, the arbitrage is what you're suggesting.
That could change quickly. If rates went down substantially and we had a lot of short-term investments, then, maybe it makes sense, but I don't know.
There's no reason why we couldn't hold it in either a capital fund or just hold it and get interest on it. So
That's
next time sand comes up, it's not such a sticker shock, right? We go, because every time sand goes up dramatically, right? And so when we get that next bill for 18 million, it's going to be 21 million. It's already approved.
It's a brat fund. We look at some of the items that we have, bathrooms and pavilions and stuff like that, and using the brat fund for that. But when we have to pay for sand, that's coming out of everybody's pockets from a ad valorem standpoint, really.
No, it's coming from the brat. That's brat.
Accommodation tax.
So brat covers
Nourishment and
that covers 100% of our debt service.
on the sand.
No, so it covers a portion of it. Remember, we have that,
Right.
that built into the ad valorem taxes too. That-
Oh, yeah, I'm sorry, yeah.
Right. So ad valorem taxes, if we had no debt, ad valorem taxes could go down.
We subsidize.
We had no sand debt.
Yeah.
So ad valorem tax, the incremental dollar in sand in debt related to sand is coming out of ad valorem taxes.
Okay.
That's why our tax rate is so high.
Exactly.
So we gotta pay that.
So sand,
18 million or 14
beach nourishment doesn't come out of
years.
brat. A small portion, but
Yeah.
most of it comes from ad valorem. So if you save some money and you say, hey, next time we need to do it, we've already got 3 million put away. That means we don't raise ad valorem taxes to cover that.
Exactly.
I'm great with keeping the money. I love keeping the money. I like that. But I think if we're going to keep the money, we ought to be lowering taxes and using that money we've kept to cover the emergencies. We shouldn't be doing both, because then unless we want to come up with a real plan to pay for the future $44 million expenditure that's sitting out there. But I'm
Can I just dumb down?
comfortable with that.
Yeah, can I just dumb down what I'm hearing?
Yeah.
For myself. So basically it's like, I don't want to keep on adding emergency money into our budget if we're not spending it every year.
Right.
Yeah.
Or over inflating legal fees because it's hard to figure out what they're going to be. I completely understand. We have no idea what's going to come up. So we could have legal fees for something. maybe we set up a portion of the fund for, but my opinion is, first of all, council should be involved if we're going to make major legal expenditures, which I think we are. But if we have a source for that money and it's not an ongoing legal expense, then, that's reasonable for us to use our savings for that one-time legal issue. Assuming the LGC and everybody likes that idea, that's, who can speak for that?
So if I'm hearing, Zach, let me know if this is
I mean, does that make sense?
feasible, that we develop a budget with one with and then one looking at a reduced tax rate of, based on your input.
I'd say it's 6,000.
6 cents.
The other thing is.
Well, or you just do one budget and just identify what that excess would be as in a
That's
review.
fine. Right. Yeah, that's fine. Right. The thing we got to realize is that we look at, I think everybody knows this, but we look at 65 cents. You got to add 34 cents on top of that because Brunswick County's taking 34 cents. So our tax rate's above $1, which is high. I mean, that's higher than any of my other tax rates that I pay. And I pay some pretty expensive governments, which is kind of ridiculous, but it's a lot. And I know we're paying double for a lot of things. I know why it's high, but I feel like we need to be concerned about it. It's a big expense for people that live here. People's insurance is getting canceled right and left. Club dues go up. I mean, market prices are high. If we can do something that would make it more livable for taxpayers, to me, that would be a huge positive in terms of managing our constituency that we just talked about in the best way possible. Anyway, that's my rant. I'll stop.
So when you're looking at it from that perspective, it's like you're holding everything constant. And it's like, wow, these numbers, we don't need to spend this money on this stuff. We should be able to lower the taxes. And there's a part of, at least my take on it is a little bit different. I agree with everything you were saying, but I think that when you're looking at, I don't even know how to describe it, extra money. It's like, we have extra money, let's take it out of the budget and lower the taxes. I think that we have that other responsibility of looking at, well, what do we want the community to be in, the kind of on the abstract level. And it's like, well, the thing that we're calling extra money is not extra money. We haven't been investing in improving the parks. We haven't been investing in these other things. So maybe, when you were doing the 5 million, 3 million, it's like, well, okay, yeah, maybe there's $2 million worth of stuff that we should be doing because our community is growing and we want to have these things for.
But our community is not growing. It's growing 1.2% a year. It's not growing. I mean, it is, but it's not growing. It's not like Southport or Brunswick County.
Yeah.
And I think if you tell people, hey, we can do all this stuff without raising your taxes, that's great. But what we really would be telling people is we could cut your taxes by 6 cents per 100, or we could build bathrooms in a pavilion. Which one do you want? Do you think about how many people are going to answer that question and what their answer is going to be?
Well, I'm anxious to hear that.
Yeah, because I think, in my opinion, you're going to get a large percentage. They're going to say, cut my taxes.
Yeah.
Fine.
Overwhelming percentage.
Yeah. Because,
I've never heard of anybody tell me they want to raise taxes to do this thing.
Because I also get the other side of that.
But there's a way to do it without raising taxes.
Not really. Because what we're saying is we're going to take the money that we could be using to cut taxes and we're going to spend it. And so my view of this is we're going to take that money and we're going to leave this extra in the budget. And we're going to now spend what we could be calling our contingency money. We got to tell people that you could be paying 58 cents per 100, but you're going to be paying 65 cents per 100 because we spent this stuff on other things.
I got it. Yeah.
Okay, so the cost of doing these things is, I mean, the list of stuff is 1.2 million. That's about 5 cents per hundred right there. Okay, so there is a tax impact of doing these things. We do not own this money.
Right.
The taxpayers own this money and we're spending it. And so we can't look at this as, oh yeah, we can do all this without raising taxes. If you do it, you're raising taxes.
Yeah, I'm not disagreeing with that. I think I'm anxious to hear how many people would say, no, I'd rather have you cut my taxes. Maybe that's going to be the case. There's, being in this position for a little while, it's like and it's not just this position, but when I was on council before, every year, and especially election year, it is so dangerous right now that we should have bicycle paths here and there. And if you tell us like, yeah, we're not going to have bicycle paths, we're going to cut your taxes. I want to have that conversation. I want to have the conversation with people like, what do you want this community to be like? And you're paying more taxes, right? Because we're going to have it that way.
And that's the question. The problem
That is the question
that gets asked is, do you want bicycle paths? Oh, sure. I mean, of course.
But it can't be,
You want bicycle paths, or do you want to pay an extra $500 a year?
That's what's got to be asked.
And, I look at this, about spending $30,000 on something is $25 per taxpayer. Would those taxpayers, if they were given the choice, would they vote and say, yes, I want every taxpayer to spend $25 on it?
Or would they buy a $25 ticket to the event?
Right. The answer to that's no, clearly. So I think we need to be thinking about it that way. I understand that we have a responsibility to provide some leadership above and beyond what the average taxpayer can see, because they're not exposed to all this. But I do think that we have a responsibility to listen to them when we're trying to assume that they need things and they'd rather us pay for them out of their tax money than let them decide whether they want to pay for these things. If you give people $25 back and there's 600 people that rent their houses want to get together and each pay 50 and do a concert series, let them do it. But don't make the other 700 people pay the $25 because you think the 600 want to do it. If they want to do it bad enough, they'll get it done. So I need a red hat. Where's my red hat? I can put on for that stuff.
No, look, these comments are very productively provocative. I mean, and I think that it's really great, especially Slaughter put a lot of thought. The $25, would you pay $25 for those concerts? Because that's what we're doing if we use it with your tax dollars. That's a good way of thinking about it. Peter, I think that your point of let's get some input from the community makes some sense. I think our bias, I mean, I confess mine as well, is that people want less taxes, and they want the basic services, but they would choose not to do some of these things. But Peter, you make a good point. It's good to hear it. But I think the point that Slaughter's really making is, and Scott's been making this along too, is let's hear it. Let's make decisions about these things, and let's find out, because we by not making a decision and just budgeting as we have in the past, we are making a decision. So let's actively make the decision one way or the other.
Well, let's make sure we have all the criteria making the decision on hand, as opposed to just making a decision.
And Peter, in this case, I think that all of this list of 1.2 million, most of that's coming from the excess BRAT funds. So that's a different, I still would argue that that's affecting everybody's ad valorem tax rate, because all that money still is not being used to reduce your taxes. But
Or diverted from beach renourishment. Yeah.
Right. I think that that even if we decided to spend the money out of the BRAT fund, we still have enough money in our general fund balance to cover the contingency, the potential $1 million that we would need to spend. So I think you actually can do both if you want to.
Right.
I'm not advocating that, but what I'm saying is if we can do both, at least do the tax cut. And then we can talk about the other stuff with the contingency from the BRAT fund, with the excess from the BRAT fund.
So the tax cut thing, right.
I'd just like to know, again, It's all based on last year's budget. I have no idea what increases are gonna be. Maybe there's stuff out there in the capital budget that we need to spend that not aware of. All that makes perfect sense to me. But basing it on last year's budget, if I were redoing it, that's what I would be advocating.
Yeah, and I just think that, I think I said when I first came in today, after yesterday's meeting, and you look at the AIA study, like, shoot, we're gonna be the number of valves, all these different things that over the course of the year. So, I don't want to be going each year, it's like, oh, we gotta raise your taxes again, because we didn't take into account that we're gonna be replacing all these valves. If I know these expenses are coming, and this is something that, this is a study they did, like, these are expenses coming, be prepared for them. I just want to make sure that we're not going down the hole that I think we were in before when it came like to paving. I want to be looking at, these are expenditures that we're going to have in 2 years. Let's start building up that capital toward that expenditure.
That's
the things we know.
That makes perfect sense, yeah.
Yeah, any kind of capital reserve, I'm 100% behind.
Yeah, that makes
Let's start to do that.
Okay. You done over there?
I was just looking for a cue.
Okay. Good stuff. Thanks, Zach. Really good.